Okay, let's dive right into this explainer. Today, we're tackling the ultimate investment showdown. We are putting IPOs up against established mutual funds and individual stocks. If you've been managing your own money for a while, you already know the hardest part isn't just figuring out where to put your cash, it's figuring out how to balance risk so you actually make money without losing your shirt. So, we're going to break down exactly how these three vehicles really work under the hood. We'll rely completely on the insights from our source material so you can set yourself up to grow your wealth and protect it too.
Right off the bat, here's the question that plagues pretty much all of us. The second a huge, hyped up unicorn company announces it's going public, should you chase that IPO hype? I mean, if IPOs can theoretically create massive overnight wealth, we have to ask whether you should aggressively jump on that next big listing or play it safe and protect your savings. Really, what we're dealing with here is a behavioral tug of war. It's classic FOMO, the fear of missing out. On one side, you have relentless media hype and those legendary stories of early tech investors striking it rich. But on the other side, the very rational fear of losing a huge chunk of your capital. To navigate this, we've got to strip away all that marketing noise and look at the cold, hard, objective financial facts. So here is our roadmap for today. We'll start with the allure of IPOs, move into an IPO reality check, then compare your investment options, figure out matching the investor to the investment, and finally, building a balanced portfolio.
All right, part one.
The allure of IPOs. So, why does everyone rush in? Well, our source material outlines four massive reasons why investors, both the big institutions and regular folks, absolutely flock to new public offerings. First up, you get to catch a company early. You're grabbing equity during its high growth phase before it's heavily saturated and traded everywhere. Historically, getting in at that initial offering price can give you a massive head start. Second, the sheer potential for crazy listing gains. When you mix the limited number of shares available from the underwriters with overwhelming day one market demand, that price can absolutely skyrocket. Third, if the underlying business model actually succeeds over the long haul, getting in early sets you up for exponential wealth creation. It's literally like hopping on a prototype rocket. And finally, diversification. IPOs give you direct access to totally new, disruptive business models and emerging tech that you just couldn't buy into before. But wait, let's move to part two, the IPO reality check. If getting in on the ground floor is so amazing, why shouldn't you dump every single dollar into the next big debut? Well, here is the harsh reality. The risk is astronomical. Unlike established stocks, these newly listed companies have zero proven, long-term trading history. You are essentially flying blind. You have no idea how the stock will react to a recession or market stress. Plus, thanks to all that initial excitement and aggressive marketing by investment banks, valuations can get wildly expensive. You're paying a massive premium just for the hype. And here's the kicker. Listing gains are absolutely not guaranteed. If the financial reality doesn't match the opening day hype, or once the insider lockup period ends and a flood of new shares hits the open market, that expensive price can completely collapse. You definitely do not want to be the one left holding the bag.
Okay, let's step back and look at part three, comparing your investment options. This is where we bring ourselves back down to earth. Looking at the structural differences between these choices makes everything so much clearer. Think of mutual funds like taking a really safe, guided bus tour. They're managed by institutional professionals, giving you deep, immediate diversification. And honestly, our sources note this is still the most reliable approach for the vast majority of people. Now, established stocks, that's more like driving your own car. You have total directional control over what sectors you invest in, but taking on that single company risk means you've got to keep your eyes on the road and continuously monitor your holdings. And then there are IPOs. They sit at the extreme end of the spectrum, our high-risk, high-return rocket ship. They demand the most intense fundamental research and carry the highest absolute risk, all for the chance of that massive reward. Moving on to part four, matching investor to investment. Who should actually choose what? If you are a beginner or honestly just someone who wants long-term diversified growth without the daily heart attacks of market swings, the professionally managed mutual fund is your best friend. This is for the set-it-and-forget-it investor. By taking this systematic approach, you're building a massive psychological wall against panic selling when the market inevitably takes a dip. You're basically paying a management fee for peace of mind, knowing the pros are handling the rebalancing so you avoid those classic emotional investing mistakes. Now, what if you crave control? If you have the financial know-how to rip apart a balance sheet and want to steer your own ship, you fit the individual stock investor profile. But let's be real, this requires serious heavy lifting. We're talking about reading through dense 10K filings, listening to boring quarterly earnings calls, and actively tracking complex economic shifts. It is a huge time commitment. But hey, if you're totally willing to do the work, you get to keep the strategic steering wheel firmly in your own hands. And finally, the IPO route. Listen, you should only put capital here if you deeply understand company valuation models and, more importantly, you have a stomach made of iron. The source material is super clear about this. Early price swings can be violently erratic during that initial price discovery phase. You have to be totally ready for insane volatility, especially around key events like when that insider rock-up period expires. You need the nerve to ride out rapid double-digit percentage drops without panicking and abandoning your core strategy.
Which brings us to our final section, Part 5, Building a Balanced Portfolio. So how do we weave all these disparate vehicles together? Well, for most retail investors, the absolute optimal setup is a multi-tiered hybrid approach. You want a massive core made up of highly diversified mutual funds. That is the unbreakable bedrock of your strategy to weather any systemic shocks. Then you complement that with a medium slice of selective, high-quality stocks where you've done the research and have strong conviction. And IPOs, they should just be a tiny, carefully researched sliver. Going all in on hype is a bad idea, but dedicating a single-digit percentage is statistically superior. By keeping the IPO slice tiny, even in a worst-case scenario where it collapses, your retirement timeline is totally fine. But if it hits a massive return, it can still significantly boost your overall portfolio yield. As we wrap up this explainer, I want you to look at your own savings and ask yourself one absolutely critical question. Are you investing for the thrill or for the future? It's completely natural to get sucked into the hype of a flashy new tech debut. We all feel it. But the data clearly shows that true, sustained wealth is built on a rigorously maintained balance, not short-term narrative hype. So take a hard, objective look at your portfolio today. Do your current asset weightings actually reflect your long-term goals and risk tolerance, or are you just chasing the next shiny object? Thanks for exploring this with me today, and keep building that resilient, balanced future.